Are you thinking about buying a home and aren't sure what to expect and how to go about it, and you're just kind of lost? In this video, I'm going to go through the home buying process so you guys can get a clear understanding of how the process goes, what to expect, and how to prepare yourself. Hey guys, my name is Shanza and you're watching the Life in Dallas channel, where we talk about all things living in the Dallas metro. And I am a real estate agent, so you guys can most definitely reach out to me. All my contacts will be down in the description box below. The first thing that you need to do is get your finances and your paperwork in order. Typically, when you're applying for a loan, they would want to see at least 2 years of work history. They want to see you consistently making money. So even if you're an independent contract worker, they still want to see consistency overall. Your gross income, should be consistent or increasing, okay, rather than decreasing. So you would need documents like your W-2s, your tax returns, your recent pay stubs, 30 to 60 days typically. They look at your bank statements, your debts. They also want you to have a good credit score and to make sure that you have the funds saved up. So typically, it really depends on what type of loan program you're using, but no matter what loan program that you're using, you're gonna need at least 1 to 3% of the loan amount for closing costs, okay? Usually it falls between the 2%, but I just like to say 1 to 3, just so we have a broader range to work with. That's just kind of like a rule of thumb, 1 to 3%. So make sure that you have enough money for down payment, for closing costs, and money left over in reserves, because you do not want to clearly wipe away your savings. That's not a good financial decision. Anything can happen. You're going to be a homeowner. This is going to be a huge responsibility. You need to have rainy day funds in your account just in case something happens, you lose your job or something. You still want to be ensured that you're going to make those payments, okay? So the 4 loan types that we have is we have the FHA, which is geared mostly towards first-time homeowners, and then we have VA, which is for veterans, and then we have conventional, and then we have USDA, which is more for like rural areas, and you're only eligible in certain areas. For VA is 0% down. For FHA, lowest is 3.5% down. And then for conventional, lowest is 3% down, and then USDA is 0%. But you also have to take into factor that credit scores play a big factor. 620 is a good credit score. You want to stay above that to get more favorable terms, but you can still get these loans if you have a lower credit score. Just know that your interest rate is going to be higher. You want to have the best credit score possible to get the best rate and terms. So for FHA, for example, if you have like a 500 credit score, now some lenders won't take it, some will. It's literally a case-by-case scenario. They evaluate everything, your debt to income, which we'll talk about in a moment, income, how much money you have in the bank. So there's several factors that go into that. But if you are lower than 580, you're going to have to pay 10% down on FHA. And if you're above 580 on FHA, then you can pay 3.5% down. So again, make sure that your credit is top notch. If you have any high interest credit card debt, it's good to pay it off, and then keep your utilization low as well. That way it can help your credit score as well. Don't try to close any accounts. Don't try to pay off your car. No, and when you're closing accounts, it takes a hard hit on your credit. So just make sure to don't do any of that when you're about to apply for a mortgage. Just wait until you're closed on your home to do that. So you don't want to do that during the pre-approval process or once you're under contract. Don't mess with anything that will affect your credit, getting new credit cards, financing a car, paying off and closing accounts. So just stay away from all that until you close, okay? Because we want to get you the best terms, and the interest rate plays a major factor in getting you those favorable terms. Again, if you want credit advice, then deal with a credit expert that can best help you. I'm not a credit expert at all. So if you want to go through that route, hey, make sure to do that. Rule of thumb, your debt to income ratio should be 36% debt to income ratio, which is the total monthly reoccurring debt payments divided by the total monthly gross income. For example, if you have $1,500 of monthly debt payments that you have to make and your income is $4,000, take that divided by 4,000, which is 37.5%. That's your debt to income. That's a good range. Staying in that 36%, but the max that they would allow, kind of stretch it out to 45. Yes, again, some do take 50%, up to 50% debt income on some of these loans. But again, this is a case-by-case thing. It depends on the lender. It depends on how much money you have in the reserves. It depends on your credit. So there's other factors as well. So we like to stay below that 45% level. The rule of thumb is that no more than 28% of your gross monthly income should go to your monthly payment. Okay, and again, this is gross monthly income. The whole lending process, they take your gross yearly income, not net. So they're not accounting for taxes and other things. This is when you will have to go and set a budget, because the subscriptions that you have, whether it's Netflix, Amazon, whatever it is, this is not counted in the debt to income. You want to make sure that you still have money left over after all your expenses are paid, because hey, owning a home is expensive. You have taxes, you have insurance, you have the principal interest payments that you have to make. So it's a lot that goes towards that. You don't want to give 75% of all your income to that and then you have nothing left over, okay? And using all that information, they're going to come up with the max amount of money that you can spend towards your monthly payment, and then from there they'll give you a pre-approval amount. Now, lenders, you want to pick multiple lenders. And I'm saying this because you want to compare rates. You don't just want to stick with one and be like, okay, this is the one that I'm going to go to, because they're all going to give you a different rate, different terms, different fees. So you pick which one you want. And typically I will refer you my lender, but then I would also require you to use like a local credit union or your bank, or like a lender that, you know, your family member used, or whatever the case is, or just you can look at them online or whatever the case is, you know? So have options, because in that 13, 14 to 30-day time period when your credit is pulled for the pre-approval, your credit can be pulled multiple times within that time frame, okay? So it won't affect your credit. Versus if you're waiting a month, then hey, that's another hard pull on your credit. So typically I like to be safe and stay within the 2-week time period. So in that 2-week time period, it's advised that you go to these lenders and then you get an estimate of fees, which is usually called a fees worksheet or an estimated closing cost sheet. And this will merely be an estimate, but this will lay out all the fees that are going to be associated with getting a loan from that lender. Give you a nice idea on your closing cost. They're going to write fees such as what's the origination fee, which is no more than 1% of the loan amount, appraisal fee, credit check fee. There's going to be all these fees on there, okay? And they're also going to tell you, you know, what your principal and interest payments are going to be. So if you're getting a fixed loan, then the interest and the principal does not change, but the insurance and property taxes do change, but it still gives you an estimate on what you can expect. And typically you do pay the insurance for the whole year up front. But you know, everything will be explained to you by either your realtor or your lender. So any questions that you have about that, you'll get an idea on the amount of money that you need to bring to close. Okay, and this will account for any down payment assistance or grants that you might get. So now that we have that done and we got the pre-approval, now that comes the fun part, is home shopping. We want to stay realistic, okay? We got a pre-approval amount. Let's not look at homes like even at that rate. I like to look at homes like just below the pre-approval, so we have a little wiggle room, because there are a lot of communities that have HOAs and that will change your monthly payment, which can change your pre-approval amount. So again, pre-approval does not exactly mean that you qualify for that amount. That's why, just to be safe, we like to shop a little bit below that pre-approval amount. And you want to create a needs and wants list. Okay, needs is something that you have to have. It's non-negotiable. Okay, like it needs to have 3 bedrooms. Another need would be that you need to be in the city because you want to be close to your job. That's a need. A want is like marble countertop, okay? So we want to look at the potential in a home rather than literally imagining ourselves living in the condition that it's in. If you find a perfect home, and I say the perfect home, especially for first-time home buyers, 8 out of 10. If you give that house an 8 out of 10, it's absolutely like a 10 out of 10 in my book. So make sure, again, that you're being realistic. If you see a house, it's perfect, it's an 8 out of 10, you just hate the color of the carpet, you hate the color of the stairway bars, whatever the case is, if it can be changed but everything else is 8 out of 10, then do not pass up that house, okay? Because a lot of times first-time home buyers, I mean, this can be your starter home. This is not the house that you're going to live in forever. This might not be the house that you're going to live in forever, okay? So just keep that in mind, that, you know, we do have a lot of people that get discouraged because they may fall into the lower price point, but this is where you can start building your wealth. Because a couple years from now, you can sell that, use that profit, and put it down on a new home. And that home will probably be closer to your dream home or your dream home. A lot of times people go through 2-3 homes to get to that dream home. So just keep that in mind, first-time home buyers. So from there, say you like a house and you're like, okay, this works for me. Then we put in an offer. So this offer can be below asking under asking. It has different terms. It has different contingencies. So that's all going to be decided, with you and your agent and what works for you. So from there, you send in the offer. It can be rejected, ignored, or it can be counter offered. Okay, and from there you do what you have to do, do negotiations if you have to. If they accept it, great. Now when you get your contract accepted, you are under contract in a legal binding contract. The title company comes in and they facilitate the transfer of ownership to the seller to you. So they hold all the funds. They're the ones that are distributing the funds. We don't give the funds directly to the seller. So there's typically 2 payments that you're going to need to make when you're under contract, when you just become under contract. You're going to have to pay an option fee. An option fee is the option for the buyers to inspect the property. So we're going to pay for 3, 5, 6 days, however many days. Let's just say 6 days. This is our due diligence period. So within the 6 days, we're going to do all our inspections, all our negotiations. Let's just say $300 for a 6-day option period, okay, for example. If the contract is terminated during the option period, then the seller gets the option money. If the contract is not terminated, $300 is going to go back to you towards closing, okay? So that's still going to be a credit towards you because you paid. And also during that time, you're going to pay what is called a earnest money deposit. And this is basically a good faith deposit to the seller showing that, hey, we have the skin in the game, we're going to purchase, because obviously we don't want to waste the seller's time. So this is kind of insurance for them just in case if we bail mid-deal. So if we decide to, illegally terminate the contract, then they get to keep that earnest money as damages. But if we terminate the contract on legal terms, if we didn't get approved for the loan a certain amount of days, we can back out and we can get our earnest money back. But that's where it kind of gets tricky, and you want to make sure that your realtor explains to you that earnest money, it can be lost if you don't decide to abide by the rules of the contract, okay? So earnest money is usually 1 to 3% of the purchase price. Again, this will be credited back to you during closing, okay? So sometimes they have several contingencies in there, like if the appraisal doesn't come in, then you guys can back out and get your earnest money back. So that's all stipulated in the contract. So once you're under contract, this is when the loan approval process will start, and this is where they start digging deeper into your finances, looking at recent pay stubs and your work history, and they also calculate any HOA dues, any taxes, homeowners insurance. This is when you're going to start shopping for homeowners insurance as well, something from your company that states that you're still employed with them. And this is a critical phase where you do not want to quit your job. This is not when you want to open new lines of credit, like I mentioned before. Just stay neutral and don't act crazy, okay? Don't go ahead and get all happy and finance a new car. This is when the title company is going to do their job. They're going to run the title search, make sure that you are getting a clear marketable title, making sure that the person who's selling the property is actually the owner and there's not somebody else who also needs to be on there and have their signatures. This is when appraisals happen. Appraisal is basically an opinion of value. So this is when the lending institution sends out an appraiser to appraise the property, because they want to make sure that the house that you're buying is actually worth the amount that you're purchasing it. The bank wants to make sure that just in case you default on the loan, what you're putting up as collateral, which is the house, that it's actually worth the amount of loan that they're giving. They have terminology in the contract that states that if it doesn't appraise, then you can terminate the contract, get your earnest money back, okay? Either the seller can come down on the price. So that's when you start negotiating as well and see what works. So there's still options. Yeah, all that will happen. It'll get sent back to the loan officer. This is when they prepare to getting final approval for the loan. And when you do, then you are clear to close. That means that you have been approved. Congratulations. So once you're clear to close, they will give you your closing disclosure, which accounts for all property taxes, homeowners insurance, HOA fees, taxes, everything is going to be in there. They're going to tell you how much they're charging for origination fees. So all the fees for the title company, all the fees from the lender, everything is going to be on there. This is everything that you need to pay. So usually 24 hours before you close. This is when you do a walkthrough on the property and see that everything is the same. The seller did not make a big hole in the property or anything like that. Everything is, how you saw it last time, and there's not any dents and cracks that weren't there last time, or whatever the case is. So we do that. And if there is, you can obviously address it with the sellers, get it fixed or something like that before you actually close on the house. And the final walkthrough went good. Then it's closing day. This is when the sellers, buyers are at the closing table. This is mostly just paperwork and disclosures. And this is when the deed is going to be signed over to you. So Closing is just signing documents, and it's kind of like a fast process, and then they account for all the credits that you might have gotten. So everything is going to be in that closing disclosure, and obviously you can ask any question that you want if you're unsure about anything, just to guarantee that you understand. And that's when closing happens, and you get the keys, and right when you sign all the documents, you can go ahead, and that's your house. You can move in that same day. The closing is usually a smooth process if the title company did everything in their part, because there are times where a title company calls days before closing saying, hey, this is a clouded title, like, okay, why didn't you tell us that before, and then you're officially a homeowner. Congratulations, now you have acquired one of the best assets that you can in your life that will help you build wealth. It will help you to buy an even better home in the coming years. You have huge responsibility now. You need to start managing your money better if you weren't doing that before. Make sure that you have reserves in your bank for up to at least 6 months, because never know when your employer can be like, okay, like, we're letting you go, bye-bye, and you want to be prepared for rainy days, okay? So start making better financial decisions now that you're not a renter, you're an owner, and anything can break down in the home, may not be covered by insurance, or whatever happens, you know what I'm saying? You always want to be prepared for those expenses. So by the way, if you guys got any value from this video, please make sure to leave a like and hit the subscribe if you guys want more content like this. Again, I am a real estate agent, so I'll be more than happy to help you guys. You guys can definitely reach out to me. All my contacts will be in the description box below, and I hope to see you guys in my next video.